Okay, let's dive into this. Welcome to the Explainer. Today, we're looking at a really fascinating contradiction that's playing out in real time with a company called nLIGHT, ticker symbol LASR. We're going to put their financials completely under the microscope, comparing the market's current euphoria against the cold, hard data of their balance sheet. And what we've uncovered is a classic paradox. There's just a massive disconnect between market momentum and the underlying business reality.
So can a stock actually soar nearly 800% while simultaneously losing millions? It sounds like a trick question, doesn't it? But this is the central mystery we're going to unravel today. You know, in the stock market, we usually assume that an exploding share price means a company's fundamentals are just firing on all cylinders. We assume they're generating massive profits, growing cash flows, the whole shebang. But what happens when the financial gravity of a business points straight down while the stock price shoots to the moon? We're going to take a really structured journey through nLIGHT's financial data to figure out exactly how this happens, and more importantly, what it actually means for anyone trying to understand the true value of this company.
Let's start with Section 1, the rocket ship reality, astounding market momentum. Now, what's really interesting about this slide is the sheer magnitude of this number. Look at that, almost 798% trailing 12-month price growth. We are talking about a stock that has basically multiplied investors' money almost 8 times over in just one single year. I mean, in the investing world, capturing a return like that over a full decade is considered a massive win. Seeing it happen in a single year tells us that momentum trading has completely taken the steering wheel.
But, as you can see, that momentum hasn't exactly been a smooth ride. Look at the wild, stomach-churning volatility over these last few years, down almost 58% in 2022. By 2024, it was down another 22%. And then suddenly, boom, explosive triple-digit gains in 2025 and 2026. It is a violent roller coaster, completely detached from any sort of stable, predictable growth.
Moving on to Section 2, a fortress of liquidity, safety on the balance sheet. Whenever we see price action this crazy, the very first thing a prudent analyst does is check for basic survival, right? Are they going bankrupt? Well, let's compare these two metrics. On the left, a current ratio of 3.79. That means for every single dollar of short-term liabilities nLIGHT owes, they have $3.79 in highly liquid assets just sitting in the bank ready to pay it. That is an incredibly comfortable cushion. Over on the right, the debt-to-equity ratio is practically microscopic at 0.09. This tells us they operate with basically zero long-term debt. Honestly, from a pure survival standpoint, their balance sheet is an absolute fortress. They've got plenty of cash and absolutely no heavy debt anchors pulling them down.
Let's move on and see how this builds because, having a fortress balance sheet is fantastic for survival, but surviving is not the same thing as prospering. You can have a vault entirely full of cash, but if your day-to-day engine is just burning money, eventually that fortress is going to crumble. We really need to look at their actual operations.
Which brings us to Section 3, the profitability problem, the core business engine.
Okay, this is where we really start peeling the onion, and where that massive disconnect becomes glaringly obvious. On the top line, they are genuinely generating sales. They brought in over $261 million in the trailing 12 months. They have a product, and customers are actually paying for it. But when you factor in the cost of actually running the business, manufacturing, R&D, admin costs, they are losing over $23 million at the bottom line. So the engine is definitely running, but it's burning way more fuel than it's creating.
To really put that loss into perspective, their net profit margin sits at a pretty dismal negative 21.44%, meaning for literally every single dollar of revenue nLIGHT brings through the door, they are effectively losing 21 cents. That is not just some operational hiccup, that is a severe structural leak. As things stand, the more they sell, the more they're just scaling their losses.
So, the crucial point is, when we evaluate management's efficiency, how well they actually use money to make more money, the returns are deeply negative across the entire board. Return on invested capital, negative 17%. Return on equity, negative 10%. Return on assets, negative 7%. The data tells a super clear story here. The operations of this company are currently destroying capital, not creating it.
That leads us nicely into Section 4, the valuation disconnect, pricing reality versus intrinsic value.
This is where we bring it all together and compare all that fundamental data against the market's current price tag. And the multiples, they are staggering. A negative PE ratio of 160 basically means there are no earnings to even speak of. But look at the price-to-sales ratio of 1630. Investors are paying over $16 for every single dollar of sales.
Sales that, as we just saw, are actively generating 21-cent losses. Add in a price-to-book ratio of 17, and it is undeniable. The market is paying a totally euphoric premium for a business that fundamentally loses money.
Let's just anchor ourselves to the present reality of the stock market for a second. Right now, shares of nLIGHT are trading right around $75.61. This price point represents the collective speculative hope of the market. It's that rocket ship reality we discussed at the very beginning, driven by momentum, hype, and short-term trading. But what actually happens when we strip away all the hype and run the actual cash flows through a valuation model?
And this brilliantly illustrates the final blow. When you calculate the intrinsic fair value based on the actual cash the business generates, you get a target price of just $2.24 per share. Compare that to the current price of $75.61. That results in a mathematical margin of safety of negative 3,271%. I mean, wow. This isn't just slightly overvalued. This is a monumental, genuinely terrifying chasm between what the business is functionally worth on paper and what traders are happily paying.
Which leaves us with this vital final thought to ponder. The market has assigned nLIGHT a massive $4.26 billion market cap. Now, on one hand, you absolutely have a fortress balance sheet and astronomical price momentum. But on the other hand, you have a business losing millions, posting deeply negative returns on capital, and sitting on a mathematically terrifying overvaluation. So, does this massive price tag reflect a future business reality that the financial models just can't see quite yet? Or is this the ultimate momentum trap, just waiting for gravity to pull it all the way back to a $2 fair value? It's a critical distinction to make and an essential lesson in separating price action from true fundamental health. Thanks for joining me for this explainer. Keep digging into the data, and I'll see you next time.